Good morning,
Good
everyone.
morning. Good morning, sir. Good morning, sir.
Okay. So this morning, we are looking at two topics. First, we will look at market failure. After the market failure, we now look at public sector audits. So that is how we are going to address it this morning. Market failure is just a short topic that we can discuss within 20 minutes, 10 to 20 minutes. So, but majorly what we need to discuss mostly this morning is public sector audits. So, but let's look at market failure first. What do we understand by market failure? Market failure can be referred as a situation where free market mechanism fail to allocate resources efficiently. What that means is that market failure means a situation where market is no longer efficient in the allocation of resources. What do we mean by that? It means where the law of demand and supply does not determine the price of goods and services. That means the forces of demand and supply does not determine the price of goods and services. We know the law of demand that said the higher the price, the lower the demand. The lower the price, the higher the demand. But in a situation whereby there is increase in price, higher the price, demand too still increase. That means that market has failed. That market has already failed in the allocation of resources. So in a nutshell, what market failure simply means is a situation where there is increase in demand despite increase in the price of that good and services. As the price is increasing, the demand too is going up. That is a market failure already. That market is no longer efficient in allocation of resources, in satisfying the need of the consumer. So that is market failure. This concept of market failure challenges the classical and neoclassical economic view that market is a free market. So now, the next thing we need to look at in this market failure is, what are the sources of market failure? How do we now result into market failure? Why will an economy experience market failure? What are the causes of this market failure? Number one, monopoly. Monopoly means market power. Where you have a single seller in a market, it is only one person producing that good, that items, or it is only one person rendering that such kind of service that people require. So there is no competition. It is only one providing that good and services. Indirectly, that is a market failure. If we have a monopoly, the seller, we have only one seller. If the seller increase the price, since the consumer don't have any alternative, they don't have any option, they will not have any option than to buy despite increase in the price. Take for instance, if you look at our downstream industry, assuming we don't have competition in the downstream industry, if we are okay, we have a local refinery, at the local refinery, you should be the one producing the finished petroleum product we are using, PMS, AGU, and so on like that. That the independent marketer should not import the petrol. There won't be competition. That local refinery will just be increasing the price. It can be selling fuel 2,000 naira per liter. We doesn't have any option than to buy. But the way government ensure that there is a market, the regulation is that even the marketers too can import fuel to the Nigeria. Do you understand? Despite we have our local refinery, they want to use it to break the monopoly in that market. Because when we have a monopoly, it is the seller that will be dictating what is going to sell the goods and services. Because the buyer don't have option. He will still be demanding, despite excessive high prices of that product. So since the buyer don't have any option, no alternative, he will still be demanding for it. So monopoly is one of the sources or causes of market failure. Another sources of market failure is externalities. The word called externalities. What do we understand by externalities? Externality means the cause or benefit of an economic activities that affect third parties. So how does it affect market failure? How is it a source to market failure? The activities of some other parties. Take for instance, during the war between the Ukraine and Russia, look at the price of goods and services, most especially imported products. The price increased because some of those products, like flour that they use to manufacture bread, to produce bread, the price go up because some of these products, they are produced in the country where they are fighting the war. Indirectly, they are using their own crisis, their own internal conflict between the two countries affects our other countries. So externality means when the activities of one party is contributing positively or negatively to another parties. So market failure, one of the sources is externalities. The reason why there will be increase in price of goods and services despite the increase in demand may be because of activities of another parties. Take for instance, when there is a war in another countries, between two other countries, it can affect another countries. Look at early this year, the war between the USA, Israel, and Iran. Look at how it affects the price of goods and services globally. It even affects Nigeria. We are even up to now, the impact of that crisis is still affecting the economy globally. So that is another sources of market failure. This externality, we are still going to look at it extensively in this topic. We are still going to look at the externality extensively in this topic. Another causes of market failure that we have is uneven income distribution. Uneven income distribution. Our income level is not the same. We have the higher income earner, we have the lower income earner. Uneven income distribution means some people are earning more while some people are earning less. We have wide income gap between the higher income earner and the lower income earner. So for those who are earning more, who have income, the higher income earner, if the seller, the producer of goods and services increase price, they will not feel it. They will still want to buy despite increase in that price of goods and services. But the buyer, the lower income earner, will feel the impact. So since the seller is increasing the price of goods and services, the seller is now thinking that people are still buying it. And whereas those who are buying it, they are the higher income earner. This higher income earner will use their own affect the lower income earner. So the seller will not have any option than to increase the price more. Do you understand? Like I said, I know of a person that said even if they are selling price of PMS 5,000 naira per liter, he's still going to buy fuel and on AC from his car. That's well, how much is you understand? So some people don't feel the impact of the economic hardship. They have the income already. So these kind of people, they are the kind of people that the producer, the seller, the manufacturer will be using as a base to increase the price of that good or price of that products. So uneven income distribution. There are some people, they are living in an extreme poverty life. They are living below the minimum standard. Why some people, they are living in a good life where organized environment, good standard of living, they have the income. So majorly, we have 3 sources of market failure. Number 1 sources, monopoly. Number 2, externalities. Number 3, uneven income distribution. So these are the sources of market failure. Let's look at this uneven income distribution. When we have uneven income distribution, when the gap between the higher income earner and the lower income earner is too large, is too wide, what will be the effect? They are going to be increasing poverty. Increasing what? Poverty. Because it's either you belong to the high class or the lower class. When there is no middle class, the poverty level in the economy will increase. And there will be social what? Another effect of uneven income distribution is social unrest. Even if there is large gap between the lower income earner and the lower income earner, the rich too, the higher income earner, they will not enjoy their money. Because the lower income earner, those who are living in poverty level, will be constituting a lot of security threats to the higher income earner. If you say they cannot enter your house, you will be driving out now, you will be going to work, you will meet them on the road. You have a good security in your estate. They can't come. You will meet them on the road. You will go to market and buy good. You understand? Social unrest, they will not rest you. They will not want you to rest if the gap is too much. And some of them too, you will be using them as your cleaner, as your security. Social unrest. So uneven income distribution can lead to increase in poverty, social unrest, reduction in access to education and healthcare. If the gap between the rich and the poor is too high, the poor cannot breathe. They will not have money to go to school. They will not have money to treat themselves while they are sick. They will not have access to good healthcare. So these are results of uneven income distribution. So what government need to do to tackle uneven income distribution is to introduce progressive tax system, which government have done. Our personal income tax is indirectly progressive tax system. It's directly progressive tax system. If you look at our company income tax extensively under the new tax law, it's progressive. Another thing government can do to tackle uneven income distribution. Social welfare program. Introduce a social welfare program to the lower income earner. Government have done that in the past. We have there is one fund called that government introduced that they normally give the market woman. I think 50,000 or 100,000. They call it I cannot remember the name. They want to use it to eradicate poverty. They give it to lower income earner. Social welfare program. Organize a training, a welfare program where you are going to cater for the lower income earner, those who are living in an extreme poverty level, by looking at what are you going to be, what palliative are you going to be giving them every month. Minimum wage legislation. Another thing government can do to tackle uneven income distribution is to introduce a law that will state that this is the minimum wage you must pay a staff. And every company that employ must comply with that minimum wage policy. Presently now, the minimum wage is 70,000 naira, which cannot even feed a single person. A gate man that don't have wife, that don't have family, 70,000 cannot feed him in a month. Ideally, looking at the economy reality, minimum wage should not be less than 250,000 naira now, based on what the economy is looking like. Because that person receiving minimum wage is going to rent house, is going to feed himself, is going to transport himself to work, do a lot of things. 70,000 naira times 12, 840. By the time that person is staying in, maybe the person is now living in Lagos, he's doing a gateman work, he's doing a cleaner, he's living in Lagos. Averagely, for you to secure an apartment in Lagos, even if it is a single room, you have to have nothing less than 400,000, 450. If you go to the less area, the rural area within the Lagos territory. Take for instance, you want to live in the eyebrow area of Lagos. You cannot even afford that. So, minimum wage legislation. Public education and healthcare. Government, because of uneven income distribution, poor cannot afford to send their children to school. So, government too, they should introduce a free education. Education should be free. Even in abroad, there is free education in abroad. Public, most especially primary and secondary education, it should be free. So that people will not have excuse that because I don't have money, I cannot send my children to school. Government, you have to be the one. It's one of your responsibility. Provide free education, free healthcare service. So this will tackle on even income distribution. Employment generation programs too will tackle on even income distribution. So that is what we need to know on even income distribution. So majorly, we have three sources of external market failure: monopoly, externality, and uneven income distribution. Now, justification for government intervention in the economy. We are still on that topic called market failure. Under the market failure, we need to look at another heading called justification for government intervention in the Nigeria economy. Why will government control economy? What are the reasons why government need to regulate economy, need to intervene in the economy? What are the reasons why government don't need to leave the manufacturer, the seller alone? What are the reasons why government need to tell the manufacturer that this is the price you need to sell that good and services? So this is the kind of product you need to produce. So, do you understand? Why government control economy? Why government control the seller, the buyer? the manufacturer, the producer. Why government intervene in the buying and selling? So justification for government intervention in the Nigeria economy. This, my colleague have already mentioned it. While you are doing introduction to public sector accounting, my colleague, Mr. Wasil, have mentioned this. These are the macroeconomic objective of government. Justification for government intervention in the Nigeria economy is the same thing as macroeconomic objective of the government. What are the macroeconomic objectives of the government? Number one, like I said, full employment. So one of the justification why government intervene in the economy is to provide full employment, is to ensure that everybody is fully engaged. They have one or two things to do. Look at it now. Go to the major city within the Lagos state. You will see some able body. They don't have any meaningful job. They are sitting down in the bus stop, walking on the road, begging for money, doing a lot. They don't have any job to do. These kind of people, if somebody now tell them that, you have a mission, we have one mission to give you, you, at the end of the day, if you can succeed in that mission, you will be paid maybe 2 million naira, 1 million naira. They will do it. That is the reason why the rate of crime increase. Most of the able-bodied young men and women go to the bus stop within the Lagos state, come to Yaba under the train station. You will see them. Some of them are even sleeping in the train track. They don't have anything to do. So government need to ensure that they engage such kind of people. It's not providing them employment. Just full employment does not directly mean government will give everybody job. Government should create an enabling environment. Those who don't have, who are not a graduate, government should ensure that they have a skills, train them. Government should have a learning center where people can train most of those handwork. So that they can be contributing positively to the Nigeria economy. Full employment means government should create a job opportunity for people where they will learn on how to do something, how to produce, where they will learn entrepreneurship. It's not about, it's not only government should be giving job. Everybody cannot be working in office. Government cannot provide job to everybody. Government cannot employ everybody. It's not possible. There is no country that do that. But train them. Ensure that people are well, they have the skills and knowledge on some of the handwork, some of the craft work, and empower them, support them with grants once they are done with the training, so that they can be self-employed. Self-employed is the way forward to the growth of the economy. It's not about working in office, sitting down in office. Everybody have to, 50% of the population have to be self-employed. If you go to China, the number of people who are working in the office, they are not much compared to those who are in the self-employed. Some of them, they will have their own handwork producing. What we are using in Nigeria, some of them, they are the one producing it through the self-employment. It's not about, so it's, everybody cannot work in office. Everybody cannot be an accountant. Everybody cannot be a lawyer. Ensure that they are self-employed. So full employment. Another justification in the Nigeria economy is general price stability. Government intervene in the Nigeria economy, which is one of the macroeconomic objectives, to ensure that price of goods and services are stable. When we have general stability, this will curb the impact of inflation. This will address the inflationary effects on the economy. So general price stability is one of the justification for government intervention in the Nigeria economy. Another justification for government intervention in the Nigeria economy is equitable distribution of income. Government want to distribute income. Government want to ensure that our income distribution is equitable in the sense that the gap between the higher income earner and the lower income earner is not too wide. You understand? It's not too wide. So that is one of the justification for government intervention in the economy. Another justification for government intervention in the economy, desire for economic stability. Government want to ensure that our economy is stable in terms of employment, in terms of price of goods and services, in terms of productions. We have a stable economy. We have a revived economy. We have a productive economy. Desire for economic stability. So this is one of the reasons why government intervene in the Nigeria economy. This is one of the justification for government intervention in the Nigeria economy. Balance of payment equilibrium too is one of the reasons why government intervene in the economy. Government want to ensure that our export value is more than our import value. Government want to ensure that what we receive within the country that will have value to our GDP is more than what we are paying out outside through importation of goods and services. So when we have balance of payment equilibrium, indirectly this will result into favorable balance of payments. This will also have impact on our local foreign exchange rates. Our local currency will appreciate against the foreign currency. Another justification for government intervention in the economy. Why government intervene in the economy is to provide public good. There are some good government provide them free of charge or at a subsidized rate. So one of the reasons why government intervene in the economy is provision of what? Public goods. So what are the methods of government intervention in the economy? What method government use to intervene in the economy? We know them already. Fiscal policy method. What are the fiscal policy methods? Government expenditure, public debt, taxations, budget, and so on like that. If government want to use fiscal policy to control economy, government can increase tax when there is too much of money in the circulation. When the economy is booming, everybody is having more money. There is too much of money in the circulation. When we have too much of inflation, government can increase tax. By that, it will address the issue of inflation. It will address the issue of too much of money in circulation and so on like that. If we are in the era of, if we are in the economic recession, the economy is not booming. Most of the companies are closing down. They are relocating. Government can reduce tax or give tax incentive or give tax holiday. By doing this, more investors will come to Nigeria. Those who are presently in Nigeria will not close up. They will not liquidate. They will not relocate to other countries. It will cease giving tax incentive, tax holiday. We still sustain them to continue doing business despite the economic hardship. Another method of government intervention in the economy is monetary policy. We know this. This is used through the agent of government, like central bank. This is used through the agent of government, like central bank. What are the monetary policy? We have open market operation, bank rates, moral suasion. We have a liquidity ratio, etc. This is what central bank use to control the economy. as an agency of government. So they are the agent of federal government. They use it to monitor the economy, to control the economy. Another method that government use to intervene in the economy is through price control. Government sometimes they set a price control system. There's a body called price control body that regulates the price of goods and services. In some other country, you cannot just sell your goods and services anyhow. It is the government that will determine the price that you sell it. It is the government that will determine the price the buyer will buy it. You cannot just fix your price. It is the government that will determine the profit margin that you put. This is price control system. Even in Nigeria, we have had it in the past. In the 80s, 70s, we have a price control system body that regulates the price of goods and services in the economy. So, Biola, what is your question? Hello?
Yes, I can hear you, sir. Good morning, sir, Mr. Idris. So my question is on that fiscal policy. In the explanation and the notes, I see that you didn't give us the types. I know I've seen it in the past question, and that's
Yes,
on
we have
one side.
there are two types of fiscal
I'm talking
policy.
about this question, sir. They asked today's question. I have a question. Yes, I know, sir. So the other
We
one
have
is
two types of fiscal policy.
I don't want to drag us back too much like that. Hello,
Okay,
sir.
please.
I'm still asking my question. So I just don't want to drag us back. So in your last topic, which is on hello, sir. I'm not true, sir. I'm still asking my question. So the other
Go
question
ahead.
there is a question I raised on the platform. Sorry, sir. And I noticed that you didn't answer it. So you are talking about grants and in terms of monetary fund only. So, and that was what was on the definition. So I know that sometimes governments, international bodies can give equipment, machinery. So I want to know which categories those grant for, sir. So those are the two questions I have, sir. Thank you, sir.
Okay, thank you very much. On your first question, when you look at fiscal policy, this fiscal policy of government, we have two types. We have expansionary fiscal policy and we have, I think, contraction fiscal policy. Expansionary means what government can do to ensure that economy is favorable, that will favor the economy. When we are experiencing economic hardship, what government can do that will ensure that we have favorable economy. When we have too much of money in the circulation, what government can do to reduce too much of money. So on that two type of fiscal policy, I will discuss it more in another topic. I understand your point. So I will discuss it more in another topic. So concerning your question, you said you raised last
Please hold on for 1 minute. For this one that I said the types of fiscal policy, and for the fact that she has mentioned that it has actually appeared in past questions, can we review this study pack to include that so that during reading we can actually capture this?
Well, I've not seen that in past question, madam. So I don't know which year of the past question you mentioned. Yes. Ever since I've been reviewing the past question of public sector accounting, I've not seen that. So when you are talking of the type, it's an extensive public finance and business finance topic. It's not in our public sector. We should understand that we are doing public sector. So time cannot permit us to be saying that we want to break it down, this and that, this and that. Do you understand? So, but if you need that, I will send the material on that. Please. Do you understand? I can review this area and I can send the material on that. Do you understand? So, but we should have it in mind for us sending lecture material. If the lecture material is too bulky, too complex, it will discourage students from reading it. Do you understand that?
That is true. That brings us to Idris, because these feedbacks are very important. That material being bulky and that may discourage students from reading enough. That brings me back. I would like to be blunt here because I've gotten feedback. I thought I would give it to Adejuwon. Your second, Mr. Wasiu, he practically reads the material to us. It's not, people are not assimilating like what you are doing and explaining it. So maybe it's a feedback to him. He should learn to explain these facts, because if you can read it on our own, we won't be in class. Thank you. I don't want to take your time, but it's a feedback.
Okay, my second.
Yeah, he reads the facts to us. He does not take time to explain it. He just comes to class to read to us.
Okay. This is well noted, madam. We will try
Okay,
to
right.
address that. Thank you.
It's all right.
Please,
Thank you.
for the sake of time, any other question, I can address it after the lecture, please. Or while the lecture is still going on. We still have a lot to do, ma. So please, kindly permit me to proceed. So at the end of the lecture, or before we end the lecture, we still have more time to entertain more questions. Please, so that we not drag ourselves back. So just kindly note your question down. You can send your question through chat box. I will look at those questions, please. So another method that government used to intervene in the economy is the area of commercial policy. That means regulation of industries, regulation of business. Government regulate business. Government regulate export. They have an export policy. They have an import policy. Do you understand? Introduction of custom duties on some of the imported products. Discourage some importation of some harmful goods. Do you understand? Some contravene goods. These are commercial policy. And commercial policy also entails that there are some industries that you need, if you want to establish those industries in Nigeria, those companies in Nigeria, you have to have some criteria. You have to meet up with some standard. Take, for instance, you can't just say you want to set up a microfinance bank or a commercial bank. There are some requirements. There are some capital base you must meet up. This is commercial policy. Everybody cannot just jump into financial institution. Likewise to insurance industry. Everybody cannot just jump into insurance industry. Government regulate them. Government give them some policy, some law that for you to be in this area, this is what you need to meet up. Do you understand? Everybody cannot be an importer of PMS. Do you understand? Everybody cannot say, I want to go into downstream petroleum products. Do you understand? I want to be selling gas, AGO, and so on like that. You have to register with government. You have to meet up with some criteria laid down by government. These are government policy. These are commercial policy. Those rules and regulations that government set up to regulate commercial activities in Nigeria, to regulate companies doing business in Nigeria. This is also used as one of the methods that government use to intervene in the Nigeria economy. So these are one of the government methods that government use to intervene in the Nigeria economy. So that's that. Now, still on this market failure, one of the sources of market failure that we talk about is called externalities. What do we understand by externality? Like I said, externality, they are the benefit or loss. It can be a cost or benefit derived by one party as a result of activities of another parties. I think I've explained this last week in our lectures. So externality means those gain or loss that derived by an economic agent. That means it is derived by one party as a result of what? Activities of another party. Your own activities, I'm deriving gain from it. That is externalities. If maybe you are producing a good, from that good you are producing, me as an individual, I'm deriving a lot of benefit from it. That is externalities. So please, let's try to mute our audio so that we can enjoy ourselves. That is externalities. So as a result of that. So please, let's try to mute our audio. I don't know who is this. We say only. So externality means those benefits, costs arising from production or consumption of goods and services that affect third parties. So that is externalities. Now, what are the type of externality that we have? Majorly, we have two types of externalities. We have negative externalities and we have positive externalities. We have negative externalities and we have positive externalities. What is negative externalities? Negative externality means, let's start from positive. Positive have to come before negative. Positive externalities means those gain or benefit that is realized by one party due to activities of another parties. Example, infrastructure development. If government construct a road, good road, like Lagos Coastal Road, Lagos Calabar Coastal Road, look at that road. Those who have land within that area is going to contribute positively to them. The value of land within that area will appreciate by the time government finish the construction. Do you understand? A lot of business is going to open up within that area. Do you understand? So that is positive externalities. Who spend the money? Government. They are the one that spend money to do the Lagos Coastal Road, Lagos Calabar Coastal Road. Who is now benefiting? The resident, the people living within that area. They will have a good road.
Who are the government financiers?
Do you understand?
That's
They
where
will have a good road. Those who have land within those areas, those who have a building within those areas, the rent price will increase. Please, let's try to mute our audio. Who is this? I don't know who is this.
Mute your mic.
Please, can we all just mute? Please, just mute, please. Thank you.
Please. So, infrastructure development is one of the examples of positive externalities. Research and development activities too. Research and development activities can result into positive externalities. Like now, Coca-Cola, they may spend a lot of money to develop a brand of new products. Do you understand? Maybe they feel that people, their customers are complaining that they need to buy a bottle of Coke that will not be more than 100 naira. They may say, let's launch maybe 10 liters bottle of Coke so that people can able to buy it. They will be selling it 100 naira instead of the one of 35 liters selling 500 naira. Let's launch the one that they will be buying 150. They will do a lot of research and development activities to develop that product. By the time they launch the product out, they start selling the product, despite spending a lot of money. What will happen? Their competitor will look at it. Coca-Cola have done a solo Coke. They have done a solo bottle Coke. What do we do? Let's start our own too. Let's launch our own. You understand? Indirectly, for their competitor, they will not spend much money to develop that product because they have looked at the brand Coca-Cola have produced already. They have looked at that brand. So they will just spend a little money to develop their own. That is positive externalities. They are making a gain or benefit from activities of another parties. So that is what is called positive externalities. We have another, the second type of externality that we have.
Mr. Awasiu, is Coke and Biggie an example of this?
Yes.
Okay, thank you.
So I don't want to mention a product name. You know, we are in a lecture and the lecture is an online. So that negative externalities. What do we understand by negative externalities? Those are the losses suffered by one party. The losses suffered by one party, one economic entity, due to activities of another party, due to activities of another party, or due to activities of another economic unit. What do we mean by that? Your own activities, I'm deriving a loss from it. From what you are doing, I'm deriving a loss from that activities you are doing. That is negative externalities. That is negative externalities. Example of negative externalities. Example of negative externalities. What are the examples of negative externalities? We have air pollutions. Air pollutions. Some of the factory located in an area, in a city, in a particular area, those people living in that area, they will be receiving a negative externality of air pollution from the plants, from the generators, from what they are producing. Do you understand? If you go to, take for instance, Ewekoro, while we are going to Abeokuta, you can see some cement producer, cement manufacturer within those areas. Look at people living in those areas. You will see a lot of white dust that have covered the house of those people living in those areas because of production of cement activities, because of extraction of limestone and so on like that. That is negative externalities. Indirectly, that dust will affect the health of these people living in those areas. Water pollution. This one addressed to Niger Deltas. The oil and gas company, the upstream oil and gas company, they will go to the onshore to go and extract crude oil from the water. At the end of the day, while they are doing the extraction, while they are doing the drilling, all the water is going to be polluted with crude oil. Most of the people that are doing fishing, they will not be able to go to the water and go and fish. People who are benefiting from drinking the water, they cannot drink the water again. This is negative externalities. At the end of the day, the area is going to be polluted with a lot of acid and some other finished products, some other raw materials, unuseful raw materials that are extracted from as a result of the drilling. So noise pollution too. Noise pollution. There are some generator, the noise within that, people living within that area may affect. It may affect the people living within that area because of the noise of those generators, because of the noise of their business activities, and so on like that. We have some event center that are located within some area. People living within that area, they will go and complain. Take for instance, we have a body in Lagos State called Lagos State Environmental Protection Control Agency, LASEPA. They have to regulate those event centers, those churches, those malls, those mosques, religious places using noise speaker. So they have to make sensitization that you don't need to be using noise, a noise speaker that will be affecting the other people within the communities. So this is negative externalities. So now, see on the externality, we have two causes of externalities. Majorly, we have two causes of externalities. We have production externalities, we have consumption externalities. One of the causes of externality is production. What do we mean by production externalities? This means when somebody is deriving gain or loss from production activities of another parties, while you are deriving a gain or loss from production activities of another parties. That is production externalities. We are deriving a gain or loss. A situation where a gain or loss is derived by one party due to production activities of another economic unit. That is production externalities. Take, for instance, in Niger Delta, if you look at it in another angle, oil and gas company, they are producing in the Niger Delta. By producing in the Niger Delta, a lot of Niger Delta indigenes they are employed. Apart from that, those oil and gas companies too, we also do a lot of social responsibility to those people within the Niger Delta area. Some of them are even giving scholarship to study in abroad. That is production externalities. Consumption externalities. You derive a gain or loss due to consumption activities of another economic agent or another economic unit. So that is consumption externalities. Somebody smoking cigarettes. You are sitting down beside the person and you said, you are a man of God. You don't smoke. The smoke of the cigarette indirectly is going to be affecting you. You are a best friend to somebody that is drinking alcohol, that can drink to the extent that the person will not know what he's doing. And you went to an event together. The person now drink. You say, you are a man of God. You don't want to drink. It's going to affect you indirectly. That is consumption externalities. So, ladies and gentlemen, this is what we need to know on market failure. This is all what we need to know on market failure. So, thank you for having me on this. So, this is what we need to know on market failure. So, like I said, most of your points you noted in this market failure, most especially in the area of fiscal policy, I'm going to look at it. So, I'm going to address it. So, what we need to know mostly on this market failure, we can be asked, what are the sources of market failure? So they can ask us on that. They can ask us justification for government intervention in the economy, or they ask us method of government intervention in the economy. Do you understand? And they can even ask us, we should differentiate between production externalities and consumption externalities, or they ask us to differentiate between positive externalities and negative externalities. So somebody want to ask a question, ask before we produce. Our next topic we are going now is public sector audit. So we are moving to public sector audit now. So before we move to public sector audit, you can ask your question. So in the case of no question, so we can now move to public sector audits.
Hello, sir. Can you hear me?
Yes, Ake.
I asked a question on the chat box that about price control. Why is price control not effective in Nigeria? I don't know. If you could throw more light on that. Thank you.
Yes. Well, your question, why price control is not effective in Nigeria? Why? It's because of ineffective government regulatory policy. Government, they have a body up to now that need to be controlling the price of goods and services. But those bodies, they don't carry out their responsibility effectively. You understand? Government, they don't lead by example. Do you understand? They don't carry out the policy effectively. Though, in the last 3 years, apart from price control policy, we have a consumer protection agency. We have a federal consumer competition and FCC protection agency and so on like that. Those bodies, federal protection, consumer protection competition agency, those bodies, they are trying on their own. You understand? But in the issue of price control agency, maybe government have done in the past, they observe that before a price control policy can be implemented in Nigeria, there has to be a lot of things that need to put in place. Firstly, government need to know the number of sellers, those who are producing. Government need to know the statistics. Government have to have the database of the companies that manufacture in Nigeria, those companies that are trading in Nigeria. Government need to have their database. If government have their database, that is when government can say they want to control them. Do you understand? In other countries, why price control system is very easy is because most of what they are doing is being regulated. Government have their database. You understand? And government can monitor them electronically. If you sell a good and services in other country, while you are transferring the money, government is aware of the transaction. Government have the database. So everything is working in other countries because most of what they are using is based on IT, information technology. So for us to have a good price control system in Nigeria, we have to ensure that the database of the seller is captured electronically. It's captured electronically. We have the database. If government capture them electronically, at the end of the day, government can monitor their inventory, how they sell their inventory, how much profit they make, what type of tax that they need to pay, as they are paying the tax. Do you understand? So I believe in the future, a lot of reformation, government is doing a lot of reformation to ensure that we have a price control system. One of them, in the area of taxation, we have an e-invoicing. There are some companies now, as they are making sales, as they are generating revenue, Nigeria Revenue Service, they capture the revenue already. You understand? They compute the value-added tax automatically, and they deduct the money from their bank statement automatically. E-invoicing. You understand? We have that. That started last year. So most of the big companies that have the large turnover, they have been captured on e-invoicing. You understand? Indirectly, government is monitoring their activities. So if government and under the new law, that e-invoicing too is going to be extended to the small companies too. Do you understand? As government is doing that, indirectly, we may have a price control system.
Thank you so much.
Yeah. So public sector audit. So can we see the screen now on the public sector audit? Hello?
Not yet.
Okay.
No, sir, not yet.
So public sector audit. What do we understand by public sector audit? What is an audit? This public sector audit, let me just summarize it. How do we audit government ministries, government agency, government corporations? That is what this topic is talking about. Who is responsible to audit government ministries, government operation, government agency, and so on like that? This is what this topic is talking about. But as stated in our syllabus, when they talk about public sector audits, as stated in our syllabus, why stating the public sector audit in our syllabus? We have to know what audit entails generally. What is audit? What type of audit we have? What are the factors contributing to an effective audit? We have to look at introduction to that general audit before we now go to what public sector audit means. But what, in summary, what public sector audit means is how do we audit government? Government too, they need to audit their account. They need to audit their financial statement. Like company prepare financial statement, government too prepare their financial statement. So the chief external auditor to government is called Auditor General for the Federation. Is the one that audits federal government accounts. And this Auditor General for the Federation don't report to president. He report to the National Assembly through a committee called Public Account Committee. So we are going to start by looking at what is audit. Audit is an independent examination of financial statement with objective of expressing opinion as to whether the financial statement is prepared on a true and fair view or in accordance with applicable financial reporting framework. So audit, like I said, is an independent examination of financial statement. And this is done by an appointed qualified persons. The objective is to express opinion as to whether the financial statement is prepared on a true and fair view and in accordance with applicable financial framework. Primary objective of audit. Primary objective of audit, as is stated in our syllabus in public sector. I'm not talking of general audit. Under public sector, what are the primary objectives of audit? One of the primary objectives of audit is completeness. What does this mean? To ensure that all transactions that occur during the year are recorded. Completeness is one of the objectives of audit. Do you understand? When you look at primary objective of audit, the primary objective of audit is to express opinion as to whether the financial statement is true and fair view. In another way, they will say, the secondary objective is to detect error and fraud, to detect whether there is material irregularity. You understand? And so on like that. But in this our syllabus, the way they look at it is the same thing, but they now break it down into some heading. They said one of the objectives of audit is to ensure completeness. Completeness means to ensure that all transactions relevant to the year of account, to the year or to the account have been recorded. That means that all the transactions that take place in that particular year, we should ensure that they are recorded in the financial statement. That means they reflect in the financial statement. To ensure that we do not omit any transaction, no transaction is omitted. That is the reason why we have to do audit. Another objective of audit is occurrence, to ensure that all the recorded transactions properly occur and were relevant to that year. Do you understand? All the recorded transactions properly occurred and were relevant to that year. That is another objective of audit. That transaction that we recorded, does it occur in that year? Or is a future transaction? We need to know that. Measurement is another objective of audit. This one is saying that to ensure that all those recorded transactions are properly measured. We value our transaction. If it is our property, plant, and equipment, we value them. Our inventory, we value them. We value them in accordance with established accounting policy. How do we value them? In accordance with established accounting policy. Every company have an accounting policy. Do you understand? Our accounting policy differ from company to company. My company accounting policy may differ from your own. The basis that you use to recognize depreciation may be differ from the basis we are using to recognize depreciation in our company. So another objective of audit is to ensure that all the recorded transactions are properly valued, properly calculated. Another objective of audit is to ensure that all the recorded transactions are in accordance with primary and secondary legislation. That means all the recorded transactions are in accordance with the law. What law? If it is a company, the law that regulates company is CAMA, published by CAC. We have another law, BOFIA in the case of bank, NDIC Act in the case of banks too. We have Insurance Act. All these law, they regulate company to ensure that recorded transaction follow those laws. But because if those recorded transactions did not follow those laws, you may be sanctioned by regulatory agency like CBN, like NDIC, like in the case of insurance, we call them NICOM. So regulatory is one of the objectives of audit. Another objective of audit is disclosure. To ensure that the recorded transaction has been properly classified and disclosed where appropriate. We classify them very well. Expenses that relate to rent, we classify it as rent. We do not classify it as repair and maintenance. That is, do you understand? We disclose them. So these are the objectives of audit. While you are doing public sector accounting, if we are asked to mention objective of audit, this is where the examiner is pointing your attention to. Please note that. Do you understand? If we go to the general audit, the cases differ. Do you understand? The cases differ. For those who are doing audit and assurance, you understand what I'm saying. So that they will not say, this Mr. Tunde is saying this and that. The cases differ. Factor contributing to an effective audit. What factor contributes to an effective audit? What factor contributes to an effective audit? For us to have a good audit, for us to conduct a good audit that will be more robust, that will capture all the transactions, that will ensure that will capture all the areas, all the audit gap, that will highlight all the gap in the company. For us to have that audit, effective audit, what factor will contribute to it? Number one, independence of who? Of the auditor. The auditor have to be independent. So independence of the auditor, this is very key. As an auditor, I'm referring to external auditor. You have to be independent, even if you are an internal auditor too, that you report to management. You have to be independent. The keynote to audit and assurance, the keynote to audit and assurance is independency. If you are not independent, if you are not an independent, if you cannot be independent, you are not an auditor. You have to be confident. You have to have that confidence to ask questions, to be independent. You don't need to be biased. What you need to have to be based on honest and integrities. And you don't. So another factor that will contribute to an effective audit, the adequacy and scope of the auditor's power. The adequacy and scope of the auditor's power. The scope of the auditor's power, the scope of the auditor must not be restricted. The auditors must be given a scope, a large scope to discharge his or her responsibility. To discharge his or her responsibility. Another factor that contributes to an effective audit is the expertise and professionalism of the auditors and his staff. That means the level of expertise, the level of professional expertise. That means experience. The experience you have, the experience you have in the past, your knowledge, your experience. So the knowledge and that experience of the auditor will determine whether that auditor is that audit is going to be effective or not. The skills, the audit skills that the auditors possess, the training you attend. For you to be an auditor, you have to be attending a lot of training. The way we audit keeps changing day by day. And there are a lot of new things in audit, like we have in tax. You can't say you are a tax consultant without undergoing a training. You have to be attending a training. Because the tax law change from time to time. So as it affects tax too, it also affects audit. The way we audit too change from time to time. There is a lot of new discovery in the audit process. So you cannot limit the knowledge. After all, I've been auditing for the past 20 years. Don't deceive yourself. You have to attend training. You can't know it all. Freedom of reporting, and it's another factor that contributes to an effective audit. Auditors should be given access to freedom of reporting. It should be report without any control. Unrestricted access to book and account. Auditor should not be restricted. If auditor asks for documents, supporting documents, the company should provide it. The organization should provide it. They should not restrict. Auditor, you cannot see our bank statement. Our bank statement is confidential. So what does the auditor want to audit if you can't give in your bank statement? You cannot have access to our sales invoice. You cannot have access to our purchase invoice. You cannot have access to our fixed asset register. At the end of the day, if you don't give him access to record, to book an account, that audit is not going to be effective. The auditor will just collect your money and write a shady report and go. After all, that is what you want. So these are the factors contributing to effective audit. Stakeholder support too. While you are going for audit, the stakeholder, the company that you want to audit, the staff, the finance and account staff, the CFO, the internal auditor, the board of directors, they must support you. They must give you support. They must give you support. So stakeholder support too. So these are the factors that contribute to an effective audit. One of the factors that contribute to an effective audit that I failed to mention is the qualification of the auditors too. The qualifications. The educational and professional qualification of the auditor. Somebody that don't possess a professional qualification, that will not undergo professional exam, though the person too can do audit, but you can't compare him with somebody that have professional qualifications, that have educational qualifications. So that too contribute to an effective audit. So you can be asked, what are the factors contributing to an effective audit? Independence of the auditors, the adequacy and scope of the auditor's power, the expertise and professionalism of the auditor and his staff, the resources at the auditor's disposal, freedom of reporting and quality of the nature of report, unrestricted access to record, to book and account, stakeholder to support. These are the factors contributing to an effective audit. Now, let's look at what are the legal, statutory, and regulatory framework of public sector audit. If you want to audit government, public sector, government agency, government ministry, government corporation, if you want to audit them, what are the laws that regulate the audit of those government bodies? Legal and regulatory framework of public sector audit. What are the laws that regulate them? One of the legal and regulatory framework of public sector audit is Nigeria Constitution of 1999. If Auditor General want to audit, he has to consider what the Constitution says. There is a particular section in the Constitution that states the responsibility, that talk about the appointment, the duties, the removal of the Auditor General for the Federation. There is a particular section that talk about that. The appointment, the removal, the duties of Auditor General for the Federation. In the section of the Constitution too, we have a section that establishes a consolidated revenue fund and federation account. A section establishes a consolidated revenue fund and what? Federation account. Who can differentiate between consolidated revenue fund and federation account? What is the difference between CRF fund account and federation account?
Let me just try. I think the consolidated revenue fund is a fund that takes in all the inflows, both from state, general inflows, from all angles to a consolidated account. All inflows goes in there. But the federation account, because this consolidated account, the inflows will later be shared between the federal, state, and the local government. But the federation account is specific to the federal government. I don't know.
Okay, sorry for that. You misinterpret it. You give what belong to A to B. You give what belong to B to A.
Let me contribute, sir.
Federation account is an account that belongs to, hold on. Federation account is an account that belongs to all the tiers of government. When we talk about federation account, that account, it belongs to the 3 tiers of government. It's owned by federal government, it's owned by state government, it's owned by local government. Revenue going to that
allow us to
federation
contribute.
account.
Allow us to contribute now.
Okay, yeah, contribute.
It's like only contributing. It's only one voice we are hearing. You are not giving us opportunity to talk, sir.
Okay.
For the federation account, let me contribute, sir. Federation account is an account that belongs to none of the tiers of government. None of the tiers of government can claim ownership of federation account, in the sense that the money coming into federation account belongs to all tiers of government that will be shared based on the agreed sharing formula by the time it is in. In a monthly basis, all money coming that will be eventually allocated to each of the tiers of government, either federal, state, or local government, goes directly to the federation account. For instance, the VAT. The VAT goes there directly, but it's not owned by the federal government. It is when it is now shared, federal government owned share of the federation account that doesn't belong to anybody now will now come to the consolidated revenue fund. That is the one that belongs to the federal. That is where their own now sits. But the one coming to the federation account belongs to nobody, belongs to the whole Nigeria. That's my contribution, sir.
Thank you very much. You have tried. Then you started with, he said it belonged to none of the tiers of government. You can't say that. If I were you, I would say federation account is an account that belongs to the 3 tiers of government. It is owned by jointly by the 3 tiers of government. Do you understand? The ownership is not owned by federal government alone. Both federal government owns it, state government owns it, and local government own it together. All the revenue going to the federation account, like you said, is going to be shared at the end of every month by the 3 tiers of government. Why CRF account? That account belongs to each of the tiers of government. Federal government will have their own CRF account. If federal government collect their share of federation account, they will transfer it to where? Their CRF account. Every state too has a CRF account. You also mentioned something that I need to oppose you. You said the example of money going to federation account is VAT. You are wrong. VAT have its own account separately. VAT revenue did not go to federation accounts. VAT, there is a sharing formula separately from VAT. The example of a revenue going to federation account is sales of crude oil, company income tax, oil mining, revenue coming from mineral resources. Do you understand? Development tax. So these are the revenue going to federation accounts. Majorly, federation account revenue is divided into 2. Oil revenue and non-oil revenue. Custom duties too is going to federation accounts. Custom duties too is going to federation accounts. So, but we just started the class. My colleague is going to take you a topic called sources of revenue. He's going to talk more on federation account. He's going to talk more on the other account, consolidated revenue account. He's also going to talk about development fund account. He's also going to talk about contingency fund account. Just be rest assured that we are going to give you the best of service. So as we proceed from the class, you are still going to do a topic that we basically deal with sources of revenue, that we are going to talk about that. So,
sorry, sir, for clarification, sir.
Yes.
For clarification, sir.
Yes.
Sir, if VAT doesn't go to federation account, where does VAT go to, sir? Please, for clarification.
VAT has its own account separately. VAT has its own account separately, and there's a sharing formula for VAT separately. You can go and you can browse it and know. VAT has its own joint independent account separately. They don't pay VAT into federation account. There is a sharing formula for VAT separately. VAT does not go to federation. You can browse it. Another sources of regulatory framework or legal of public sector accounting that we have is Audit Ordinance Act of 1956. Audit Ordinance Act of what? 1956. This Audit Ordinance Act of 1956 has to deal with area of audit and accountability of public sector organization. This Audit Ordinance Act of 1956 states that the account prepared by the Accountant General must be presented to who? To the Auditor General for audit. Accountant General is the CFO of the government. Is the one that will prepare the financial statement. Can I call him CFO where we have the Minister of Finance? Can I call Accountant General the CFO? But Accountant General is the one that will prepare the financial statement of the government. If Accountant General prepare the financial statement, he's going to present it to who? To the Auditor General. And Auditor General is going to audit the financial statement. So, the responsibility to prepare the financial statement, the law that states the responsibility is stated in the Audit Ordinance Act of 1956. How do we ensure accountability in public sector? Is also stated in the Act. This Audit Ordinance Act of 1956. So let's look at another regulatory framework of public sector audit. Another one. Finance Control and Management Act of 1958. This Finance and Control and Management Act of 1958 is also talking about the responsibility for the preparation of financial statements. Who has the responsibility? The Accountant General. He needs to prepare the financial statement of the federal government. And in this Financial and Control Act of 1958, it's also talking about who has the responsibility to authorize a payment, to issue a warrant. What is warrant? Warrant is an authority issued by the Minister of Finance to the Accountant General to release funds from Consolidated Revenue Fund account, to make payment from Consolidated Revenue Fund account. Who has that power to issue that warrant? Minister of Finance. Based on the instruction of the President, he will issue a warrant to the Accountant General. Accountant General cannot disburse any payment without a warrant. Accountant General has to collect instruction from who? Minister of Finance.
Okay.
Do you understand? Accountant General cannot do anything, cannot do any payment without instruction of who? Minister of Finance. All this is done to ensure there is a check and balances. Another regulatory framework of public sector audit is Fiscal Responsibility Act of 2007. This has to do with budget. This is saying that anything government has to spend, any expenditure government has to make, that expenditure must be appropriated for in the budget. Government must prepare budget at the beginning of the year to monitor the spending. Why we do the budget is to ensure effective financial control in the country, to guide against reckless spending in the countries, reckless management of public funds. So, Fiscal Responsibility Act of 2007. We have another act called Public Procurement Act 2007. This act is talking about procurement. How do we award contracts? How do we procure goods and services? We must follow the guideline laid down by the Procurement Act 2007. So if an auditor is auditing too, auditor has to look at that Procurement Act. If they say they award a contract to somebody and they make a payment of 20 billion to that contractor to construct the road, auditors has to look at Public Procurement Act. Does the award of contract to this construction company, does it in line with the Procurement Act 2007? Auditor has to consider that too while doing the public sector audit. There are procurement guidelines, procurement process laid down by the government as stated in the Act. If government want to award a contract, government have to first of all issue out a tender. They have to make a publication tender in at least, some people call it maybe 3 daily newspaper or 5 daily newspaper. They have to issue out a tender notification that we are looking for contractor, we are looking for supplier. They must publish it in a 3 national dailies. That means they must publish it in the newspaper. But left to me, all this is a wasting of money. For you to publish in a newspaper now, to say you are looking for contractor, or you are looking for contract supplier, you may spend nothing less than 1 million or 500,000. And government say, if you want to issue out a contract, any government contract, that ministry, you must publish it in the newspaper so that people everybody, so that people can see, and those who are qualified can apply. And there is a requirement for qualification. For you to qualify as a company, you must have your tax clearance, you must have your ITF certificate, you must have a PENCOM certificate, you must register under Bureau of Public Procurement, BPP. You must have a NSITF certificate. There are a lot of requirements. Your revenue must not less than a particular amount. All this will be stated in the requirement and in the newspaper. Any company that qualifies will now bid for the contract. But what I'm saying is a waste of money. The situation we are now in government, even before they say they want to publish the contract in the contract, they were looking for contract. All these now paper, they are all paper. They have already know the person that they will award the contract to. Do you understand? They are just following the process, protocol that is stated in the Procurement Act. They know who is going to get the contract already. You that you want to go and submit, that you don't know anybody, you are just wasting your money. You are just wasting your printing, wasting money to print paper, to print documents. They know who they are going to give the contract already. They have already finalized it. That is government for you. But what did law say in the procurement? So if the auditor is auditing, he has to consider the procurement as to look at it, whether there is any breaches, whether there is any whether the company comply with the Procurement Act. If the company did not comply, he must note it down. It's one of what he's going to put in his report as his management report. So these are the rules and regulations these are the regulatory framework that regulates public sector audit. Another one, we have public audit standard, public sector audit standard. So we have more of that. So please, when we are asked, what are the legal framework of public sector audit or regulatory framework of public sector audit or statutory framework? The Constitution of 1999, Audit Ordinance Act of 1956, Finance Control and Management Act of 1958, Fiscal Responsibility Act of 2007, Public Procurement Act of 2007. So there are many like that. We have to look at PSAF too, International Public Sector Accounting Standard too. if you want to audit public sector audit, you have to look at it. Does the financial statement prepare in line with international public sector accounting standard? Like we have IFRS for company. In public sector, the way we prepare the financial statement in the public sector, we have a standard that states how we present the financial statement. That standard is called PSAF, International Public Sector Accounting Standard. So that is that. Now, benefit of audit planning. Before you start an audit, you have to plan. Before you start an audit, you have to do what? You have to plan. You have to plan your audits. You can't just jump. I want to go and audit. Let me just start auditing. You have to plan. How many of these staff I'm going to need for this audit? What is the objective of this audit? What are the areas I'm going to audit? What are the time I'm going to spend in these audits? You have to plan. You have to allocate job to your staff, to your audit staff, area they are going to audit. You need to plan. So what are the benefits of audit planning? Number one benefit of audit planning, it helps auditor to divert appropriate attention to the important area of the audit. That means auditor is going to pay more attention to the important area of the audit. While we are doing audit, we normally talk about critical area of audit. There are some, if you go for an audit, we call some area called critical area of audit. That if you don't audit that area, you may not have a reasonable audit opinion. It may affect your audit reports. There are some critical area of audit. So by doing audit planning, it will help you to divert appropriate attention to the important area of the audit. Another benefit of audit planning, it helps auditor to identify and resolve potential problems on a timely basis. While you are going for audit, there are some problems you may encounter during the course of audit. If you do plan very well, you will have project that this problem may come. You will have know that this is what you need to do when you encounter this kind of problem. So another benefit of audit planning, it helps to properly organize and manage the audit so that it will perform in an effective and efficient manner. Audit planning also assists in selection of engagement team member. Do you understand? If you want to select your audit team, if you are going to audit, you have to look at their competence. This one, does it good in financial sector audit, financial institution audit? Does this one good in oil and gas audit? You have to look at their competence. You can't know it all. Do you understand? Audit is very broad. The way we audit oil and gas may be different from the way we audit financial institution. There are some law regulation that you need to consider while auditing financial regulation institution. There are some law and regulation that you need to. Somebody that have not have experience of oil and gas audit cannot jump into oil and gas audit. It's just like taxation of oil and gas, taxation of petroleum company. As me, I don't have experience of petroleum audit, hydrocarbon, petroleum tax. I don't have any experience of petroleum tax or hydrocarbon tax. So if I was given an assignment to provide a tax service, I have to engage somebody that have experience in that area. Because my own major area is company income tax, personal income tax, capital gain tax. You understand? As we have different area in tax, we have different area in audits too. So another benefit of audit planning is to facilitate direction and supervision of engagement team member and the review of the audit work. facilitate direction, supervision of engagement team member, and the review of audit work. Why we have another benefit of audit, that it is to assist, where applicable, the coordination of work done by auditor, based on the competency, experts, and so on. So these are the benefits of audit planning. Now, let's look at type of public sector audit. We are in public sector accounting. We are talking about public sector audit. The type of audit we want to mention here is based on what is stated in our syllabus as public sector audit. If you go to your general audit, it may be different from this. So you should pay attention to that. It may be different from this. And it depends on where we are looking for. If you say, type of audit, indirectly, we have external audit, we have internal audit. You understand? Type of audit. We have a value, but in public sector audit, let's look at the type of audit that they mention as stated in our syllabus. Number one is compliance audit. Number one is what? Compliance audit. What do you understand by compliance audit? This audit is an audit carried out to ensure that, to review whether organization comply with internal control policy, lay down policy, lay down law, lay down regulation in the organization. This audit is conducted to ensure that the company comply with the lay down rule and regulation, lay down company policy, lay down internal controls within an organization. The main objective of compliance audit is to provide the intended user information on whether the audited public entity follow the law, legislative act, policy, establish code, and agrees upon terms. So this is compliance audits. Some companies will have compliance departments. What they do is to ensure that we comply with the law and regulation, the lay down policy, the lay down rule. In bank, we may have compliance department. In insurance, we may have compliance department. In pension industry, we may have compliance departments. Another one is financial audits. Financial what? Audit. This is another type of public sector audit. Financial what? Audits. What is financial audit? Financial audit is an audit that is carried out at the end of the year to review the financial statement prepared by the company, to ensure that that financial statement is prepared in accordance with financial reporting policy, financial reporting framework, regulatory framework. What financial audit talk about is to ensure that if you are a company, you prepare your financial statement as stated based on what IFRS is saying, based on what international accounting standard states. You treat your financial statement like that. And to ensure that you don't have material misstatements. To ensure that your financial statement is free from error and irregularity. Do you understand? So all the audit that is carried out on the company at the end of the year, that is done by the external auditor, they are financial audits. They are financial audits. They use it to gather sufficient audit evidence that the company has complied with the financial accounting policy, the financial frameworks, the standard. And they use it to state that the financial statement is free from material misstatement, error. As we have financial audit in companies, Government to do financial audit. Or at the end of the year, federal government prepare their financial statement. State government prepare their financial statement. Local government prepare their financial statement. And their financial statement will be audited by their respective Auditor General. That is financial audits. Another type of audit we are going to look at, and this is where we are going to stop today because of time. I still have another lecture by 11:30. Value for money audit. Value for money what? Audit is another type of public sector audit. Value for money audit. What do we mean by value for money audit? Value for money audit means an audit that is carried out to review whether we are deriving maximum benefit from the utilization of scarce resources. This audit, it is used to ensure that we are using our resources, the organization resources, in the best way to achieve intended objective. Value for money audit is the review of organization resources to ensure that we are using these organization resources in the best possible way. And this value for money audit is based on 3 E's. 3 what? E's. What are the components of value for money audit? There are 3 E's. Economy, efficiency, and effectiveness. Value for money audit is based on what? 3 E's. Economy, efficiency, and effectiveness. These are the 3 components of value for money audit. You can be asked, discuss the 3 components of value for money audit, or explain the 3 components of value for money audit. What is economy? Economy means we are spending money
carefully, not paying more than necessary for resources.
Carefully. We don't spend more than necessary for resources. Economy means the process where we acquire our resources at the least possible cost. We have 3 persons that want to supply for us, and they want to supply the same product for us. If we want to consider the principle of economy, which one are we going to select out of the 3 suppliers? And they want to give us the same product, the same standard. Which one are we going to select? By looking at the principle of economy. We are going to select the one that have the least cost. Efficiency. Efficiency, another component. Efficiency is talking about how do we use organization resources. We should use it to produce maximum output. Efficiency is talking about how do we use our resources, our labor, our material. We should use it to generate maximum output. So efficiency means the process of using organizational resources, minimum resources, little resources, minimum input to achieve maximum output. Looking at labor, our labor, when we want to make them efficiency, by considering principle of efficiency, we have 3, this job we're supposed to use 5 labor to do it. If we want to follow the principle of efficiency, we can use 3 labor to make the job of 5 labor get done. That means we are using minimum input. 3 people is doing the job of 5 people, and they are getting results. That is efficiency. Where is so important for me that you need to take note. Please take note of this area. I can ask question in this area twice. And when I can ask this question, mandate of efficiency unit, I think it was asked twice or once. Most of the students that attend the question, they didn't perform very well. Over 95% of the students get less than 20%, 10% of the mark, because students don't pay attention to that. So mandate of efficiency unit. So please take note of this area. What is mandate of efficiency unit? We are still under efficiency. You can be asked, what are the mandate of efficiency units? Number one, to review government spending pattern using data from the budget implementation report and other sources. Number one, reviewing the government spending pattern using data from the budget implementation report and other resources. Number two, to work closely with ministry, department, and agency to review work procurement process for specific expenditures line. Another mandate of efficiency units is to agree changes, process improvement to reduce wastage and make savings. This is one of the mandate of efficiency units. So if a question wants to ask in this public sector audit, is one of the area question can be asked. Another mandate of efficiency unit, continuous publishing the achievements from the implementation of such changes and process improvement. To identify, migrating best practice in the public sector spending pattern and process of other countries to Nigeria is part of mandate of efficiency unit. To propose changes in the culture of public sector spending by NDA so that we can achieve prudency and saving is also part of mandate of efficiency unit. To collaborate with government institutions whose responsibility have bearing with those of the units. To identify and implement a price guideline, benchmarking of MDA, offer opportunity for quick win and large saving. All these are the mandate of what? Efficiency unit. So please, let's take note of that. The third component of value for money audit is called effectiveness. What do we understand by effectiveness? Effectiveness means using resources in such a way to achieve desired objective. Effectiveness means using resources in such a way to achieve what? Desired objective. We have desired objective. Effectiveness has to do with time. We achieve our objective, the desired objective, at the appropriate time. Effectiveness relating to labor. You may be effective, but not efficient. When you are coming to work at the right time, 8 o'clock is the result. You are effective. You are very effective. You close at the right time. You don't absent in your work, in your place of work. You are effective. But efficiency means What are you doing while you are in the office? Are you contributing to the company? Are you adding value to the company? Some people, especially government staff, they may come to office. They are in the office. They may be watching a movie in their laptop while in the office. That one is not efficient. Though they are present, they are effective. They normally come to office on time. They don't normally absent. But what are you doing while you are in the office? That is what efficiency is talking about. So these are the components of value for money audits. How do we step involved in value for money audit? We are going to stop in value for money audit today. Step involved in value for money audit. What are the steps involved? If we want to carry out value for money audit, what are the steps involved? I can have asked this question several. If you have reviewed past questions, step involved in value for money audit have been asked up to 3 times or 4 times. When you want to, what are the steps involved? Number 1 is to carry out initial analysis of the project area. What area of government resources you want to audit? Do you want to audit government revenue? Do you want to audit government assets? Do you want to audit government expenses? Do you want to audit staff? You can carry out value for money audit on staff, whether those staff are adding value to the company. That means you need to do initial analysis of the project. Under your planning, you will design the audit program you are going to use. You will design the audit program you are going to use under your planning. So, under your planning. Step 3, you need to introduce the main study area, the area you want to audit. You need to introduce it to your auditee, those you want to audit. You need to tell them the purpose of the audit, this time schedule you want to carry out for the audit, the member of your audit team, the audit objective, the method that you will use to collect data while doing the value for money audit is under the step 3. Do you understand? It's under the step 3. Step 4, you carry out compliance tests. Compliance what? Test. You test the strength of the internal control in the organization on that resources you want to audit. If you carry out on compliance tests and you are getting a good result, you may write your report from compliance tests. But if you are not getting a good result, you proceed by doing step 5, which is carry out substantive what? Tests. Substantive test is a detailed test of transaction and balances. It also includes analytical review. It's a detailed test. In substantive test, you review all the documents. You don't make use of stamping and sampling. But in compliance test, you may carry out sampling of transaction review. After you carry out your substantive test, from the results, you can start writing reports. You write your report from what you get from your compliance test, from what you get from your substantive test. You write action. Based on what you write in your report, you now follow up whether the company have started doing it. You will not sit down. You will follow up actions involved. Whether what you recommend, this company have started doing it. Follow up actions involved. What you recommend in your audit, in your report writing, whether the company have implemented, they have done it, you follow up. That is step involved in value for money audit. So, factor contributing to effective value for money audit. Question asked, what factor contributing to effective value for money audit? We have mentioned this earlier. Factor contributing to effective value for money audit is the same thing as factor contributing to an effective audit. So my laptop battery is almost down. So you may be asked, factor contributing to effective value for money audit is the same factor contributing to an effective audit. I've mentioned it at the beginning of this topic. Unrestricted access to record, stakeholder support, resources at the disposal of auditors, freedom of reporting, and so on like that. So, ladies and gentlemen, this is where we are going to stop today. So by next week, we start on internal audit. We are going to finish the public sector audit by next week and move to another topic. So thank you for having me. Do we have any questions?
No.
Thank you, Mr. Idris.
You are welcome.
Thank you.